Understanding how money moves in and out of a business is absolutely crucial, like understanding the heartbeat of an organization. We often talk about cash flow, and while it sounds straightforward, the way cash flows can follow different patterns. These patterns are really important to recognize because they tell a story about the financial health and activities of a business. There are generally three basic types of cash flow patterns we see in the business world, and recognizing them is like learning to read the financial weather forecast. The first, and perhaps most common, is the conventional cash flow pattern. Think of this like planting a seed and then watching it grow and bear fruit. In this pattern, you typically start with an initial investment, which is an outflow of cash, money going out of your pocket. This is like buying the seed and preparing the soil. Then, over time, you expect to see a series of cash inflows, money coming back in. This is like harvesting the fruit from the tree year after year. A really simple example is investing in a new piece of equipment for your business. You spend money up front to buy the equipment, the initial outflow. Then, as that equipment helps you produce goods or services and generates sales, you start seeing cash inflows over the equipment's lifespan. The key characteristic here is one initial outflow followed by a stream of inflows. It's a pattern of investment leading to returns over time, and it's often associated with projects that are expected to generate profits steadily after an initial setup period. Next, we have the non-conventional cash flow pattern. This one is a bit more complex and less straightforward than the conventional pattern. Imagine building a sandcastle at the beach. You initially spend time and effort, an outflow of energy to build it. Then you enjoy it for a while, perhaps receiving compliments, which could be considered inflows of satisfaction. But then as the tide comes in, you might have to spend more energy, another outflow, to reinforce or rebuild parts of your sandcastle to protect it from the waves. In business terms, a non-conventional pattern might involve an initial outflow, followed by inflows, but then potentially another outflow later on. Think about something like an oil drilling project. Initially, there's a huge investment to set up the drilling operation, a significant outflow. Then as oil is extracted and sold, there are inflows of revenue. However, towards the end of the project's life, there might be substantial decommissioning costs to shut down the well and restore the environment, which would be another outflow. So, a non-conventional pattern is characterized by more than just one sign change in the cash flow. It could be outflow, inflow, outflow, or even inflow, outflow, inflow in some rarer cases. It's a pattern that reflects projects or investments with complexities that go beyond a simple initial investment and ongoing returns. Finally, we have the mixed cash flow pattern. This one is perhaps the most realistic and often the most unpredictable. Think about running a small lemonade stand on a busy street corner. Some days are incredibly sunny and lots of people buy lemonade, resulting in significant cash inflows. Other days it might rain and barely anyone stops by, leading to very low inflows or even outflows if you had to buy more lemons that day and couldn't sell much. A mixed cash flow pattern is characterized by irregular and unpredictable inflows and outflows over time. It's not a smooth stream of inflows after an initial outflow. Instead, it's a fluctuating pattern of money coming in and going out, often without a clear or consistent trend. Many startups and businesses in dynamic or volatile markets experience mixed cash flow patterns. Their revenues and expenses might vary significantly month to month, depending on market conditions, customer demand, or even just random events. This pattern highlights the uncertainty and variability that can be inherent in business operations. Understanding these three basic cash flow patterns, conventional, non-conventional, and mixed, is like having different lenses to look at the financial performance of a business. Recognizing the pattern helps you understand the nature of the business, the types of investments it's making, and the potential risks and opportunities it faces. It's a fundamental concept for anyone wanting to grasp the financial dynamics of the business world.